Today's housing starts data for May hit lowest levels since June 2020. And looking more broadly, the real estate sector has been one of the worst performing S&P sectors this year. My next guest, though, says investors who remain jaded on the sector are going to miss out on the upcoming rally. Here to discuss the areas where she's finding opportunity is Tripp, Nuveen Real Estate's global CIO and head of investments. Carly, great to have you with us. I'm wondering first about office. What do you see happening to the older stock in office if it's not already selling at steep discounts? And how long do you think owners and lenders can afford a massive repricing?
Yeah, no, thanks. Happy to be here, John. Thanks for having me today. So if we take a step back, just first commenting on the overall market, because you did give a glowing introduction of our industry at the onset. But really, we are private real estate investors, which lags the public markets. Our returns are really meant to sit somewhere between equities and bonds, inflation hedge, durable cash flow with upside, obviously, through increased demand and continued growth. Private real estate tends to lag public markets, so our experience has been quite different this year than public market REIT performance. And what we're seeing is really a turning of the tide for private real estate and a bottoming process. And that's really indicative if you look at industrial as an example, which is up 9% year over year. So again, valuations are bottoming, liquidity is returning to the market, and transactions are starting to beef up again, which is all good news. As it relates to office, what we're seeing, again, you do see the fundamentals generally bottoming. We have seen net absorption positive for the year. That is indicative of a little bit of a turn. Still going forward, there will be winners and losers. Structurally in this country, we do not need the amount of office stock that we have. And we are seeing a really massive flight to quality as it relates to office demand, with tenants really requiring highly amenitized, newer space, which isn't necessarily a good investment outcome for the investor itself. They're very costly to maintain. So traditional office will continue to be challenged going forward, long-term still at risk for disruption. And overall, we are underweight to traditional office.
Tell me about retail. What distinguishes the retail real estate that's doing best right now beyond geography? Is there anything to what I'm hearing about the return of the mall, particularly in luxury areas? And what comes after, you think, the whole department store anchor tenant model?
Yeah, I mean, a little bit, right? So sales have increased. Some malls are doing quite well, very, very resilient. That said, I think retail in mixed use communities are doing best. Necessity-based retail is holding strong. When we look at retail overall as a sector, it's like kind of the Rocky Balboa of the last decade. It went through a very, very dark era as e-commerce came to disrupt it, which created this undersupply in the market. You know, you look at the last 5 years and over 100 million square feet of retail has been positioned to other uses. So the market really self-corrected when we talk about supply. So currently we are seeing the most demand that we've seen in a decade at our retail centers. Vacancy nationally is a meek 5%, which creates very, very strong conditions for the landlord. And also, if you look at forecasts for rent growth, very, very strong, outpacing inflation, and is expected to continue to do so.
Carly, it's good to have you on the show. It's interesting to hear your comments about a bottoming that we're seeing in the real estate market more broadly. I mean, we've heard similar things from Blackstone, from Ares, and a number of others. But on the flip side of that, we also know that there is this wall of debt that is in stages coming due. And if rates stay as high as they are, you're going to have a number of developers and a number of loans that are going to have to refinance and reprice at these much higher rates. How much of a concern is that? And therefore, how much does all of this hinge on monetary policy?
Yeah, I mean, it definitely hinges on monetary policy, right? As soon as we can get the short end of the curve normalized and the curve not inverted, that's a positive thing for lending conditions for commercial real estate, as many borrowers take on floating rate debt. If you think, though, further about it, I think what I would say is the bottoming that we're seeing, it's not related to office, as I mentioned. We are starting to see the corner really turn. And I think, you know, the message there is the bottom is really hard to time. However, if you're redeeming your positions and you're selling out of real estate right now, you are really selling very, very close to a bottom.